Hi everyone, this is Arif and today we are here with another unit of CIA Part 1, Unit 7, which is about risk management. This is my brief introduction just in case if you are new to the video, you can pause the video, you can read about me, or we can connect over LinkedIn as well. This is a brief snapshot of the entire CIA Part 1 syllabus. So far we have covered the foundation of internal audit, ethics and professionalism. Then we have also explored mainly there are two types of audit engagement, the assurance services and advisory services that we have covered. In our previous unit, we have covered about governance. In this unit, we will cover risk management, and in the next two units, we will be covering in detail controls. And lastly, the last unit that we will cover in the CIA part, once unit 7 is fraud risk. Here is the overall breakdown of the entire CIA syllabus in 10 units. Each unit have different level of coverage in the CIA exam, and accordingly you can expect similar number of MCQs that may appear. So far we have covered from unit 1 to 6, and by the end of today's unit, which is unit 7, we would be somewhere approximately close to 75% coverage of the entire syllabus. And in terms of MCQs, accordingly you can expect nearly 80 to 90% MCQs that might appear from this level of coverage of these CIA Part 1 unit up till unit 7. In today's unit in risk management, we will be covering about 10% of the entire syllabus, and you can expect around 10 to 12 MCQs that might approximately come from this unit. Let's have a quick brief snapshot of the unit 1, what we have covered. In unit 1, foundation of internal auditing, we have covered the purpose of internal audit, which is basically the definition of internal audit. We talk about the internal audit charter. We spoke about the independence of internal auditor and the impairment of independence. And there was a last section in which we have spoken randomly about the role of internal audit in risk management. It is very much important to understand that the last topic that we have covered in unit 1 is basically kind of introduction for unit 7, risk management. So we will start our unit with the same slide of the last unit of unit 1. So do not be confused when I would say in the upcoming slide that this is the last unit of this is the last section of the unit, because this represents the unit 1. And I'm not recording the same video again. However, I'm just taking the same last slide and putting here in this presentation just to save time, and also to keep that consistency, that in terms of if you have covered that in part unit 1, you would be able to refresh your memory with the introduction or the first section of unit 7, which is about the basics of risk management. In unit 2, we have covered different types of internal audit engagement. We have covered an overview on third-party and contract auditing, quality auditing, service and privacy auditing, performance auditing. Similarly, in unit 3, we have covered operational auditing, compliance auditing, financial auditing, management reports review, and organizational cultural audit as well. In terms of advisory services, we have covered the benchmarking engagements, and it could be of different types. And there are some other advisory assignments that internal audit can perform. For example, training and awareness on risk, due diligences, business process mapping, system development reviews, etc. Coming to unit 5, ethics and professionalism, we have covered 5 ethical values that an internal audit should demonstrate. The first one was integrity, the second one was objectivity, the third one was competence, the fourth one was due professional care, and the last one was confidentiality. In our last unit, Unit 6, we have covered different governance principles, where we have seen that the board has to give a direction to the management and all have to provide an oversight responsibility, and has an oversight responsibility in terms of proper functioning of the organization. Similarly, we have also covered the role of management and the internal audit in terms of governance, and we have talked about organization culture. Now, coming to our today's unit, which is Unit 7, Risk Management. As I've earlier mentioned, we will continue from the last section that we have covered the basic intro from Unit 1. It was the last unit in the Unit 1. This will be an intro for us in the upcoming unit for today's topic. In today's unit, we will be covering the risk management process, and there are multiple risk management models, but only two we will discuss. The first one is COSO ERM, and the next one is ISO 31000. These are the most commonly used in the organization to manage the risk within a company. So let's take it forward with the next slide to go a little bit more in detail. But just to remind you, I just simply copy paste the previous slide here to save time and to have the continuity of the same topics. So there might be an intro a bit weird because I usually try to make my videos a bit raw. I do not do too many editings, and to be very honest, I do not know exactly how to remove certain part in the video. So therefore you will find a bit weird in starting that where I will be recapping something from the Unit 1, but just ignore that. If you take into account, that's fine. The main purpose is the last section of the Unit 1 is basically the intro for this section, so we will take it from there. And then there was an earlier video which I have made on ISO 31000 and COSO ERM that I will be incorporating in this session. So overall, it will cover the entire unit of CIA Part 1. This is the last topic of our Unit 1, the role of internal audit in risk management. There are certain key important elements that we need to take into account. Firstly, as I've already mentioned, we need to know the principle, the objective, and then we have to furthermore understand the standards, how we can achieve those objectives related to the role of internal audit and risk management. So the principle 9, plan strategically, states that chief audit executive must align internal audit activities or internal audit plan with the organization's risk and long-term objectives. We will diagnose this statement into much more detail, but first go through the standard as well. The standard 9.1 states understanding risk. Chief audit executive must understand governance, risk management, control to develop effective audit strategy. So basically what happened that whenever we carry out our annual audit plan activities, we have to go and refer to certain key risk reports within the company or the activities of the risk management department. On a practical term, internal audit obtain the risk register from the risk management department and see what are the key risks, and they align those risk assessment with your own internal risk assessment, because we have already performed certain area audit activities and follow-up activities. So we also have our own independent judgment about the risk apart from the risk management department. The risk management department have their own way of compiling and consolidating and reporting the key risk of the organization to the management and to the risk committee. They define the risk appetite, which are acceptable level of risk within the company, and risk tolerance, that how far we can tolerate, and then if the organization breaks such limits, then they have to report, and the management has to take certain action to mitigate those risks within tolerable and acceptable level. So those reports are very much important for internal audit to review in order to carry out an effective internal audit plan for the year or for the long-term 3 years plans. So what are the key things that internal audit has to do? They have to understand the key risk within the organization, be it related to the data, documentation, operational effectiveness, how the operations are happening within the company. It could be related to the assets and regulatory compliance. So these are the key four elements that we can drive within those risk reports. It is also important for the chief audit executive to build an insight within the organizational risk activities and engage with the leadership, with the management as well, analyze risk report and align the risk framework or appetite in order to better understand what is the tolerance level within the organization, what are the acceptable appetite, and if there is breach of those, if there is a proper effective reporting or not. So these are direct or indirect ways by which we become more inclusive in our strategic planning, and our audit plan is much more aligned with the organizational direction and long-term objectives, and hence we provide value addition to the company. Whenever we talk about risk management, it is important to have a clarity in mind in terms of who does what. So there is a very beautiful model. We call it the IA 3 line of model, which clearly define the role and responsibilities within the organization. They break down within 3 different layers, which enables the organization to strengthen its governance. The model clarifies basically how to manage or who manage the risk, and who strengthen the governance, and who provide the assurance. The first line or the first line, previously the same model used to call 3 line of defense, which were much more easy to comprehend rather than 3 line model. So I will be using the same, but the new name is 3 line model. So just stick to 3 line model. But the word defense is important because it conceptualize that how we are providing a defense against the risk. So there are 3 walls, you can say, or 3 layers that the risk has to pass through in order to affect the organization. So if we have effective walls or effective layers, if not the first line, the second line might catch the risk. If not the second line, then the third line might catch the risk. And eventually, if all 3 fails, it might expose the company to a major risk or potential negative consequences. So let's break down the organization into 3 lines. So the first line basically are the operation people, which own the risk. For example, if you are in manufacturing, the production people, the people who handle the inventory, the people who carry out the manufacturing activities. In a construction, the laborers, they are the first line. So these are the people who roll up their sleeves and then do the dirty work and carry out the operations. In a service-based organization, these will be the people who are picking up the phones and providing the services to their clients on the front end. So these are the people who basically are the first line, which are who supposed to own the risk. Means that these are the people who has to ensure that they do their job in a more effective manner in order to not expose the organization to any risk. Then we have the second line. The second line are the people who support the first line in discharging their duties. For example, they are the people who are partially independent. They will be performing a check and balance on them. They will be creating, for example, health and safety people, quality assurance people, compliance team, risk management team. They will be periodically reviewing their work just to ensure that they do not expose the organization to any major risk, and they take care of those risks. So the second line more ensure the compliance towards the company's policies, procedures, safeguards, regulations. The third line, which is completely independent, is the internal audit, which provide assurances whether the first line and second line are carrying out their assigned responsibilities in a more effective way. And if there are any gaps, then we identify those gaps and recommend improvement. The external auditors are also part of the third line of defense. Value of the model, it prevents the role overlaps. So each individual, whoever falls in whichever classification of those defense lines, they know their role and responsibility. It enforces clear accountability and and elevates the risk-based decision making, because we ensure that those risks are properly managed, so it enables us to make more risk-based decisions. What are the key principles of three-line model? Effective governance requires board oversight, clearly defined role responsibilities, independent audit reporting, integrated. So basically, these are the key principles which ensures that we are able to achieve the clarity of the three line of defense, that we need to have a proper board oversight, that the board enable or look after the company in terms of whether the management is performing their job in an effective way or not. They clearly define the role and responsibilities. We have to ensure the internal audit is independently reporting, and integrate assurance collaboration means where internal audit might collaborate with the risk management and the management compliance team to ensure that our outcome is much more effective. So we might take their work and use as an internal audit work, but the responsibility will be on us, or sometimes we can use these departments to avoid any duplication. There could be also possibilities some external assurances are being carried out within the organization where we can collaborate with them. We have to collaborate within the organization to give a value addition to the company. So this is the last topic for the unit 1. So in the previous slide, we discussed about some of the key definition and terms that you need to know before we dive deep into the risk management process. So risk management process is a 5-step process in which we identify the context, we identify the risk, then we carry out a risk assessment and prioritization. We see what are the key risk responses that the management is applying, and lastly the risk monitoring. So risk management could be formal or informal. Many organizations have formal risk management, or ERM, we call it Enterprise Risk Management Department, where they have a proper team which coordinate and facilitate the other user departments within the company, that how they can identify the risk, and they carry out all the assessments, and they consolidate and they summarize and they report to the board. But there could be a possibility that the company in which you are working, they might not have a formal risk management department, and they still be functioning. So the question arises that if the organization does not have a risk management department, which we know a lot of the companies, they hardly have internal audit, so let alone talk about the risk management. So How they function. So does it mean that risk management is an accessory or a luxury? No, not really. Basically, risk management is still happening within the company. So having a formal setup, the structure of the company in itself is part of the risk management. Having proper job description for the people, that what they are supposed to do to carry out their performance assessment and performance annual performance appraisal. This is also part of the risk management, to ensure that the individuals and the departments are able to achieve their objectives. Then there are delegation of authority, that each individual, how much authority they have and for what they will be being made accountable. Then we have small processes within the company where the system does not allow you access without a proper authorization. You have access controls, you have data confidentiality, encryption. Then you have system controls, that if you are purchasing something, you have to go through a certain process. If you have to make a monthly payroll or pay to the people, there is a certain process. So this all related to risk management. It's just that the organization does not have a formal setup where they report those kind of risk in a formal way to the board or to the governing authorities. So risk management always happen because no one can function, be individual or the company, without risk management. Even in your day-to-day life, you see that how much salary you get, it how much expenses you have to make. You avoid any penalties or fines or defaults. This is all part of the risk management. So it could be a formal or informal process, but generally it happens everywhere. So in a formal setup, basically how risk management happen, we identify the context. So context means that if you are working in a company where you have to carry out the risk assessment, you have to understand in which sector they are working, what are the sectorial risk, what are the laws and regulation that the company in. Sometimes the setup of the company, for example, it's a public limited company or private limited company or private joint stock company or public joint stock company. This all encompasses that what are the key requirements or what are the key laws or regulation they have to follow by. So this also give you the overall idea, what are the capital or huge big investment the company is intending to do, how the business processes are being formed within the company, are they using any technology or not using any technology, and what is the impact of emerging technology on the industry or the sector in which the company is in, what is the market risk, does the interest rate, what happened to the company if the interest rate goes up or down, the consumers, how they behave, how the product or the services which the company is giving have the kind of competition within the within the environment, and there could be a lot of other factors that you can consider as part of the context before even getting into detailed level of risk assessment. Risk identification you can do either first of all, you have to see external and internal risk. So in the context, generally you see from the external point of view and see and evaluate that how those external factors will impacting your internal processes. So risk identification could be from internal and from the external way as well. It could be past or future events. So in the past, there might be possibility that there were injuries or delays or customer complaints, or future event might be that the expectation of the customers, the new regulation might be coming. So these kind of things that you can know in terms of risk identification, by which you identify all those events and to make your risk depository. You can also carry out questionnaires by which you send it to the different individuals within the company, maybe head of the department or one level down to the manager, or maybe to each individual employees, in order to understand that what are the key risks according to them in their process. And they are the best people to tell you, because they are the one who carry out the work activities day to day. So this is one of the ways by which which you can also identify risk. Escalation triggers. So again, if there are escalations and event that causes, for example, machine breakdown. So these are the escalations by which we know that the production line will be disturbed. There could be other possibility by which the individuals or the process escalates certain kind of risk. So that could be also an input to your risk depository. You can carry out workshops through which by you can allow different department units to come, and then you brainstorm with them and ask them different questions, and in a formal setup you try to identify what are the key risks and document those risks. You can conduct interviews one-to-one. Process flow is a very good way of identifying the risk by which you map down the entire process and evaluate that is there is any loopholes within the system or not. Loss events or sometime injuries reports or these kind of reports are very important, because this also gives you an indication that what are the key risks involved in different kind of processes or within the department. So these are all the ways by which you can identify all the key risks within the company. Now moving to the third part, risk assessment. So risk assessment is basically where you see what is the likelihood and what is the impact of the risk. So likelihood is the frequency, that how frequently that event can occur, and what is the impact, that how much exposure that can cause in terms of loss of reputation, in terms of fines, or in terms of losses. So these kind of things you can identify. It could be qualitative or quantitative. So qualitative risk assessment is basically where you come up with the numbers, and quantitative where you just give an average, or just you say this event is a high risk, this event could be a medium or a low risk. Quantitative is more suitable in financial sectors, financial services, because they are being even very closely monitored by the regulators, because it's involved a lot of money and stakes. So the risk management modeling and the tools which they are used are more qualitative. However, despite that, they have to use certain quantitative measure as well. And then going to risk modeling. Risk modeling is same, that whether you allow your risk assessment in a model by which you can give each risk high, medium, low, or a number 1 to 5, or this kind of assessments which you can perform. I generally prefer high, medium, low, because for me, even no matter how numerically you could be, you try to come up with a number to identify a risk as a high or medium or low, it's still subjective. There is still a lot of debate that can happen. And also when you are internal auditor, you want to execute the audit rather than just spending your whole time in doing a risk assessment, because risk assessment is important, but there should be a balance between how long does you take in your annual planning process. It shouldn't take 2 months to plan your audits and then 10 months to carry out, right? So therefore you have to strike that balance as well. Risk response, whenever we talk about risk response, that how the management behave, or what are the controls they want to place, or how they want to manage those risks. One thing is very much important, which we will be discussing the next slide in detail, that what is the risk appetite and risk tolerance of the organization, right? Because that is the gauging point by which we say whether this risk is a high, medium, or low. What are the key controls that has been placed? Control risk is one important thing, that where the control is placed but it's not effective. For example, you put a lock on the door to safeguard the assets or whatever valuable things are in the premises, but you keep the window open, right? So in that case, the control is not effective because the door is locked but the window is open, so the thief or any wrongdoer can come from and jump from the window. So this is one more thing you have to see. Residual risk is that despite applying a controls, we still left out with certain kind of exposure. For example, if you put a valuable into a vault, then what if the vault is being broken down, right? Then you can put in a room. What if the room door can be broken down? What if you make sure and try to restrict the access to the building? What if the earthquake comes? So there will always be a negligible or residual risk left over after placing the controls. What we have to ensure as an auditor or as a risk practitioner, that we strike a balance. There should be a cost benefit analysis, so our controls should not oversee the benefits, in terms of the efforts, in terms of the time, and in terms of, so it should not defeat the purpose. So we have to strike the balance. Yes, certain risk you can maybe manage very well, maybe 90 or 99%, but certain risk you might be applying a control at a level of 40 or 50, and certain risk you just simply say that to be in the business, I have to accept that risk. So then we as an auditor risk practitioner gauge those risks when the management proclaim that kind of a thing with the risk appetite, and if it falls within the appetite, we say okay. But if it doesn't, then we highlight that the management is overexposing the company, and that issue we highlight to the board. Risk monitoring is when you have done all this thing, you keep track and you keep evaluating whether the risk management process is doing well or not in managing those risks. So this is one important thing. Secondly, internal auditor can also carry out their assurance assignment or risk management, so they also independently assess whether the whole system is working in a manner that is supposed to be or not. And also the management also carry out their periodic checks, because these risks, any risks, there are black swan events. For example, COVID happened. No one knew that the mobility would be so much restricted. So these kind of event can trigger a huge risk for the company. And so therefore we need to keep on monitoring those kind of risk. So this is overall description or brief explanation of the risk management process. This is very important slide because this is one of the key critical component of risk management process, which is risk appetite. Risk appetite is basically, in simple words, that how much risk the organization is willing to accept. Risk tolerance is that the organization does not want that risk, but it can still absorb the shock. But beyond risk tolerance is unacceptable risk. Just to give you an analogy, for example, if the speed limit for any highway, especially in Dubai, for example, if the speed limit is 80 kilometers per hour, that is a desirable speed limit which is being mandated by the law, which comes under risk appetite. From 80 to 100, basically there is a grace speed in Dubai by which you can still accelerate, and the camera will not detect you, but that is mainly used to overtake another car. So they give you that grace limit, which is risk tolerance, which is not desirable to travel in that, but just in case if you want to overtake a car for any purpose, or if you just miss out that your car has been accelerated beyond 80, you still have a chance not to get a fine. But the moment you reach 100 or 100 and above, you are being penalized. So you get the ticket and then you have to pay the fine. So that is unacceptable by the regulators, by the traffic police, that you should not be accelerating your car at a speed of 100 and above, while the speed limit is 80. So the same concept goes in the business as well. So there are different events which can cause different kind of risk. So we gauge those risks with risk appetite of the company. So it's generally a formal document within the company. Not all company have, but majority of the company, they do have a formal document in which they try to quantify or describe the attribute of the risk that the organization is willing to accept, and then they define the risk tolerance limit and then unacceptable risk. For example, the CEO can expose the company to a contract of 100 million, and from 100 to 110 could be still tolerable in exceptional circumstances, but beyond 110 it's unacceptable. Then he has to get an approval from the board for bounding the company in any such kind of commitment. So this kind of the limits could be defined. Generally, if you look into risk appetite, they gauge the risk exposure towards the company revenue, that if the risk exposure could be 2% of the company, then it is unacceptable, or net profit or revenue, which I've already mentioned. So there are different parameters by which they gauge, and in some companies where they do not have the risk appetite statement, the tone of the top management or the board give you a hint that what is acceptable in the given circumstances, to what extent you can bring the company or put the company under exposure. For example, there is zero tolerance limit, zero tolerance for fraud or corruption within the company. So you know that even if there is no risk appetite defined, you are not supposed to take any bribe or give a bribe, right, or commit a fraud. Just in case if you are indulging in such activity or you are being found guilty of, you will be instantly terminated and disciplinary action will be taken. So such kind of behavior are being sometimes governed under policies and procedures. So sometimes it's formal, sometimes it's not. But generally, this is the whole concept of risk assessment, and the risk appetite and the risk tolerance. So every risk we gauge against the appetite, and if it is beyond the risk appetite, then we say it's a high risk. And if it is within the risk appetite, we say it's manageable or low risk. Or a medium risk. So this is how we gauge. So as a just for the sake of understanding, you can say if a risk exposure is within the given parameter, is low risk. If it is within tolerable limits, then it's a medium risk, and if it is beyond tolerable limits, then it's high risk. So this is how you can take this as a gauge and assess each risk event. COSO ERM framework. This framework is very much important because this is very widely used. So in risk management, you will generally find two types of framework which are widely used. One is COSO ERM, Enterprise Risk Management, and the second one is ISO 31000 Risk Management Principle and Guidelines it provides. So these are the two very important. Before going into the definition and the benefit and other details and what is COSO ERM framework, it is important to understand what is a framework is all about. So basically, as we have discussed in our in the earlier slides as well, that risk management in itself is a process by which the organization ensures that all the key risks are being managed in a way that the organization is able to achieve its objective. So this is the entire purpose of risk management process. To give a systematic approach to a risk management process, there are multiple frameworks that give you a guideline that how you can navigate this process, or what are the key elements that you should be more focused in your risk management process. So there are different people or different institutions who sat together in order to come up with the best idea that how you can manage the risk. One of the model that, or one of the concept that has emerged was a COSO ERM framework. So this is the one which we will discuss in this couple of slides. And there is another one as well, ISO 31000. Then there is a Turnbull, and there are multiple others. You might also be aware in a financial institution, there is a framework used as a Basel 1, 2, and 3. These are financial risk management frameworks. So there are multiple types of risk management framework. In COSO, in COSO ERM, what is the most important thing is that we have to integrate and embed the risk management process across the organization. It gives you a portfolio view where where each and every individual, first of all, responsible for risk management of the respective responsibility or area of competence or area of responsibility. And secondly, the thing which you have to understand that our ultimate objective is what? To achieve the organizational objectives. So that we have to achieve by encompassing or by incorporating the risk management even at the very top level, at the strategy level, at the business objective level. So it has to be very much embedded within the veins of the entire organization risk management. So this is the crux of the ERM COSO framework. Let's go quickly into the definition and key terminologies, and then I will try to explain it to you, the model in itself. So the ERM definition: the culture, capabilities, and practices integrated with the strategy setting and performance. The organization rely on to manage the risk in creating, preserving, and realizing value. So the culture is very much important. They have given an importance to the culture because no system, no controls can overcome a risk exposure unless until there is a tone, there is a vibe within the organization where everyone feel responsible, and with their good faith they act in the best possible manner in order to deliver what they are being assigned. So culture is very much important. Second, capabilities. We have to hire good people. We have to hire competent people who can carry out your work very well. They are ethical, they are honest. So this capabilities is very much important of a human resource from ethical perspective and from a competence perspective as well, where we have to guide them, we have to train them, we have to upgrade them. This is also important. And practices is what? Policies and procedures. So any organization which function, they have a certain practices, and these practices are being formalized in terms of hardcore controls and in terms of policies and procedures. So so no one is confused about what they are supposed to do, and no one, even out of negligence, they do something out of innocence, something wrong. So that's also important to have policies and procedures. Integrating with the strategy setting. So as I mentioned, that the entire risk management has to be even thought at the time of strategy setting, that whenever you are setting a strategy for your company, that how you are ensuring that the risk will be managed in a way that the organization will be able to achieve its 5-year or 10-year strategy. And performance in itself, if you take it at the core of performance management, what is the role of performance management? That to ensure that the KPIs, key performance indicators, that the goals are being achieved through KPIs are the indicators. So these performance management system in itself is one of the key element of an effective ERM, that the organization rely on to manage risk in creating, preserving, and realizing value. So value to the shareholder, value to the stakeholder. So by risk management, we ensure that we further create and preserve and enhance the value of the activity, the process, and overall the organization. So this is a very detailed level of explanation to the ERM risk management. What are the key benefits? If you have a good risk management within the company, it will increase the opportunities for the organization, because there will be less wastages, more productivity, more efficient working, transparency, accountability. And when all these things, innovation and improvement, when all these things are there, eventually the organization grow, and people or the organization itself reach out to more opportunities. Even people wants to associate with such kind of organization. Customer wants good quality product, so it overall help the organization in grabbing the opportunity. Effectively manage risk. Obviously, through better risk management, you try to manage the risk. Positive outcome in terms of profitability, in terms of efficiency, in terms of cost reduction, in terms of environmental hazard reduction. So these are the positive outcome. Reduce performance volatility. Obviously, when you have a good performance metrics, when you value people, when you hire good competent people, when you train them, when you have systems and procedures and policies in place, then there is a high likelihood that the performance will have less volatility. Improve resource deployment and enhance resilience. Obviously, resilience is one thing which derives from the overall culture, risk culture within the organization. If everyone is morally conscious about, then obviously the organization become more resilient. So overall, it helps to better decision making and enhance performance. So this is the benefit. A 3 line of defense is a very important concept that whenever we talk about risk management, we have to understand that an organization is basically exposed with a lot of risk. So in order to defend themselves from such kind of risk, the organization have a mechanism. So they first of all have a first line of defense model. They have first line, and then second line, and the third line of defense. Same like in the war, when you have first level of defense, then second and the third and the tertiary. Similar to that within the organization, there are different layers to protect the organization from adverse risk. What is the first layer? The first layer are the people. The first layer is basically the process owner, the people who are working on that activity or that process. You need to have good, competent and capable people, and they should be guided, and they should be informed, and they should be given proper responsibility, and again they should be being made accountable for that. So they are the first one who have to own the risk of their work activities and ensure that they manage in a proper way. The second line of defense are the control functions, we call it. These are supporting departments which they themselves do not drive the business, but they assist the first line units to carry out or to function well. So in first line, you can say HR, finance, marketing, sales, production, quality assurance, no, not quality assurance, so production. So these are the departments which fall in the first lines who run the business. The second line will be the support function, basically risk management, quality assurance, health and safety department, compliance department, anti-fraud department, ethics department. If you have these are the departments which basically do not help you in the operation, but indirectly or they support, or directly they support, or indirectly they manage the risk that these functions work efficiently. So risk management in itself falls in the second line of defense, which means they support the business units to manage the risk effectively. The third line of defense is the ultimate, who are the people who give an independent assurance whether the first and second line are functioning well or not. So they are the one, we are the one, basically the internal auditor are the one who falls under the third line of defense, because we independently review the first and second line of defense model within the company. We look into all the functional department, are they doing their intended job? The risk management department, are they doing their intended job? The controls are placed effectively and working effectively, and give our independent assurance and independent opinion to the board or to the management that if there are any weaknesses, we highlight the gaps and we tell them that how we recommend them also that how they can bridge those gaps. So we are the third line of defense, which means that if there is a risk which is not being managed by the first line of defense, for example finance department, and then second line of defense by the risk management department or compliance department or quality assurance department, and then that risk is still there, and the last one, if internal audit encounter and identify those gaps, then it is that the organization will not be exposed. But if they even fail to internal audit or external audit, both are basically part of the line of defense, then that risk, if it is materialized, it will directly impact the organization. So this is how the organization function. Role and responsibility: obviously the board has oversight, the management has to ensure that the risk management processes are implemented and working effectively, and the organization performance is being evaluated, and it is towards the achievement of their objectives. The role of internal audit is basically risk management department. Before that, risk management department, what is their role? Their role is basically to facilitate and help the first line of defense to identify the risk and to consolidate in a way that they come up with the all respective risk which belongs to their department. So these risks are being documented on a risk register, and these risk registers are being compiled by the risk department and to see what are the entity level of risk and what are the key status of different risks, whether it is being properly managed or not, or if there are weaknesses in the way they have identified. So they ask to and forth, they go to the process owners and the first line of defense and keep on refining those risks, and then they summarize those risks and see what are the key risks from each department, from each functional area, which might have a very detrimental impact to the achievement of overall objective of the organization at the entity level. And they come up with the top 10 or top 20 risks, and they give the status of those risks, whether they are being managed or being accepted by the management or being avoided by the management, and to the board. So the board and the top management, whenever they are making a strategy shift or they are making any strategic decision, they look into those areas as well, and they ensure that the risks are being properly managed by the management. Internal audit basically evaluate and they give the assurance on the entire process. The first line, that how they are managing; the second line, how they are helping them, and give the board and the management that if there is any weaknesses to overcome, and if it is not, then give a positive assurance that everything is going as intended in a reasonable one. Reasonable one assurance means that we give that overall things are okay, not absolute, because for absolute you have to do whole system transaction by transaction review, which is not in the best interest of the organization, because then you need additional resources. So reasonable assurance we give that overall things are okay. So this is the snapshot and overview of COSO ERM. This is the framework, COSO ERM framework. This is a new version basically. There were an old version before that. And this is the most updated one, and it's very beautiful as well aesthetically. And there is a lot of brainstorming that has been happening. Previously, just to give you a context that what was happening, that the risk department were being made accountable for all the risk, and the organization used to think that no one has anything to do with the risk. It's the risk management department who has to identify, who has to be responsible to timely inform the board, to the management, that what are the key risks that the company is facing. However, with the revised version, they made it so much important that overall the board has the responsibility to have that, to ensure that there is the risk culture within the organization. Everyone feels responsible for it. The top management is responsible for integrating the risk. The risk has to start from the very top, from the strategy setting till the very bottom, day-to-day work activities, where we have to ensure each activity is being performed as intended. So this is the positive notion that comes. And also the risk management department is cannot work in silos. It's not an isolated department. It it works with the process owner, it works with other oversight functions, for example, internal audit or business continuity, health and safety, and compliance department. So there is a lot of integration that happen at the risk management department as well. So here we are, and as with the ERM framework component, the first one is governance and culture. So whenever we talk about governance and culture, we have to ensure that the board exercise risk oversight, that they ensure that they have that the management implement processes and proper mechanism by managing those risks, and the overall direction and the importance and the tone or the culture is being derived from the very top, from the board. In order to give more oversight to the risk, the board in itself also form a risk committee, which comprises of some of the members of the board, which directly, or the scope of those risk committee is basically to look into each in detailed level of risk management activities within the company, and what are the key risks and how they are being managed. So this is how the board exercise their oversight. Also, the board form audit committee, which is responsible to carry out to ensure that the head of internal audit carry out, or the internal audit department carry out audit activities, and give an assurance on the risk management process within the company, and also to give the assurance that how the overall risks are being managed. So this is the role of the board. And also the operating structure is very much important, that how the organization is being structurally being implemented. For example, there is a board, then there is management, within the management the CEO, and then we have the head of the department, then departmental managers. The role and responsibilities are being defined. The delegation of authority has been properly defined. We have an independent internal audit department which report directly to the board and administratively to the CEO. There are proper KPIs. So this is all part of the governance and culture. Okay, and demonstrate commitment to the core values is basically means that whatever the core values of the organization is, that everyone is mindful about, and they ensures morally and technically as well through the system or process that those values are not being breached. One more important element of the governance and culture is to hire good people, to retain them, to provide them trainings and development. And by this, we are also ensuring that we have a very good resilience within the organization to face any unforeseen challenges and to be more resilient towards those challenges. Whenever we talk about strategy and objective setting, we talk about the business context, as we have know that whenever we talk about the business context, we talk about what are the sector, what are the key risks from the sector, what are the laws and regulations that affect the company, what are the geographical location of that company, and how that may pose risk to the company, technological advancement and how that impact the company, society as well, consumer behavior, the market. So this is socioeconomic factors. So this is the context. So whenever we are talking about the strategy and operating objective setting, we have to account for all these kind of element while making our strategy and business objective. We also have to define the risk appetite. Risk appetite is basically the level of the risk the organization is willing to accept, to gauge each risk against those risk appetite. It's a formal document, and to ensure that whether that risk management activities are within the framework or within the acceptable limits of the risk appetite. If it is not, then it is unacceptable and the management has to do something about it. Alternative strategies, if one thing doesn't work, we have to find ways of having plan B, or to ensure that whether the plan A is good enough because we have evaluated other strategies, activities. So this is also one of the key elements that we have to ensure in terms of strategy and objective setting. In terms of performance, we have to identify all the key risks that can have a detrimental impact to the performance of the organization, see the severity, the likelihood, and the impact of those risks to the organization, and prioritize what are the key important risks that needs to be managed very quickly and that need to be managed in a normal course of work. And then we have to then we have to find a solution how we are intending to manage those risks, maybe by putting some extra controls, by getting an insurance for those kind of a risk, or by not going for and avoiding that project which causes those risks, or simply accepting it if it is within the risk appetite. Lastly, we built a portfolio view, means that we consolidate all the risk and we ensure that these are being monitored on a timely basis, and to ensure that the organization achieves its objective obviously the organization achieves its objective. Review and revision means that assess any substantial change within the organization. Maybe there could be an acquisition, or maybe a joint venture, or maybe the organization is intended to start operation in a new geography, or a new technology, or a new product line. So those also needs to be assessed from the risk management perspective. Review risk and performance and pursues improvement again, so we have to review those, and we have to set KPIs, we have to carry out performance assessment, we have to ensure that we are able to manage those risks, and overall we have to ensure that we are in a continuous state of improvement all the time. It's not that we do carry out a risk assessment of one-time activity, or we assign or feel that only the risk management department is responsible, or internal audit department is only responsible, and everyone feel that they do not have to do anything. This is not the case. However, in risk management, it's an integrated approach and everyone is responsible. Lastly, information in communication and reporting is so much important that all the performance activities needs to be communicated in a timely manner. So if there is an adverse performance, we have to find a way to manage those risks. Also, periodic reporting also highlight all the key new risks that the company might be exposed to, or the risk which already they are managing it, and the way these reports or these information goes to the top should be in a way that it give a transparent and independent view of what's happening within the organization, not a cosmetic clean report, right? And that can only happen when there is a good risk governance or risk culture within the organization, where people are not fearful and they are confident that when they speak up their mind and when they highlight certain kind of risk, they will be not reprimanded, or they will not be put into trouble. So that is the responsibility of the top management to ensure, give that sense of security and protection to individuals. There is a saying that a good risk mature organization is where the bad news moves faster than the good news. So by this only statement, you can gauge whether you have a good risk culture within the organization or not. There are certain limitations that the weakest point, as we always say in the control, the weakest point is the human. So human can make false judgment, human can be biased, human can have a wrong intention. So the thing which can harm is the human element in the risk management. Cost benefit analysis, obviously if the cost of a control is more than the benefit, then we have to compromise on that control. Simple errors or mistake, collusion, simple error can happen. Collusion is where two or more people combine together to do something wrong. What else? Let me see. In the previous slide, we discussed about COSO ERM Framework, and we talk about what are the key components and the principles, and we talk about what are the key limitations. Here in this slide, we will be discussing about the risk management framework, another risk management framework, which is known as ISO 31000. ISO 31000 is basically a guideline which gives you a structural approach how to carry out the risk activities basically. The whole framework is basically depicted in this one picture. It talks about that whenever we are doing it in risk management activity, we have to ensure that the scope, context, and criteria needs to be taken into account. Scope, that what is the engagement scope for which you are doing a risk assessment. Maybe it could be at the engagement level, or it could be at the scope could be at the company's entity level. Context is that your organization is in which sector, what are the laws and regulation that is affecting, what are the customer base, what are the competitors. So these regulatory framework in which you have to work, taxation, laws, environmental factors. So these are the contexts which you have to take into account. Criteria is whenever you are doing a risk assessment, against what you want to measure against. For example, if you say the the manager has not taken or the manager has already exposed the company in one contract. So what is the criteria? The criteria will be delegation of authority. So in delegation of authority, the authority level and to what extent he can take a decision on behalf of the company, that will be defined. So this is criteria. Another way of criteria would be if you say the company might be exposed to a fine. This is the risk, right? But what is the criteria? What are the parameters by the law? What are the parameters by the regulator that they have put forward in order to comply with, and beyond that, which might expose to the fine? So whatever the event you are assessing against the criteria or against the standard, that is basically our criteria. So that you have to take it into account. Then risk assessment again is the same process where you assess the risk. After identifying, first you identify the risk, then you assess the risk. Risk assessment, they have broken down into risk identification, risk analysis, and risk evaluation. So risk identification is the first step. Then risk analysis is when you see what is the likelihood and impact of the risk, and risk evaluation when you try to prioritize those risks, whether it's a high risk, medium risk, or low risk. Then the risk treatment. The risk treatment is basically whether you want to accept the risk, whether you want to avoid the risk, you want to place the controls. So how you are managing those risks. So that is also needs to be taken into account. Then there are three things which we have to ensure that recording and reporting should happen. Top down and bottom up. Communication and consultation should be embedded part of the risk management process. Monitoring and review should also be embedded part of the risk management, and this is the whole process which is being given as a guideline by the ERM risk management framework ISO 31000. Let's go quickly to the ISO 31000 framework. So it basically has three components: principles, framework, and processes. The principle talks about that the entire risk management activity needs to be integrated within the organization. It cannot work in isolation where only the risk management department, you presume that they are only responsible for the risk management. However, they are the facilitator. Each and every individual within the company, from the very top to the very bottom, everyone is responsible for risk management. So that integration we needs to have, and also the integration from that the risk management should be taken into account at the strategy level, at the objective level, at the departmental objective level. So throughout within the organization, the risk management in itself needs to be very structured, systematic, and organized, and comprehensive enough for everyone to understand. Every organization is unique in itself, so the risk management activities needs to be customized and tailored bespoke to the nature of that company, without compromising on the key fundamental elements of the risk management. Inclusiveness, obviously, where we have to take into account that it belongs to the company, dynamic it change with the organizational change, best based on the best available information, that all the information that's flow within the organization like a blood should be best available information. Human and cultural factors need to be taken account, and lastly there should be a continuous improvement. So these are the key principles of a good risk management activity. Framework components are that leadership and commitment to honor at the top is very much important. The integration between and everyone should feel responsible for that is very much important. The design and implementation, evaluation and improvement of the entire risk management system is also part of the key core component of this framework. And when we talk about the process remains the same: communication, consultation, scope, context, criteria, risk assessment, risk treatment, monitoring and review, and recording and reporting. This all needs to be part of your risk management activities within the organization. Whenever we talk about auditing a risk management activity within the organization, we can take these principles and see whether these principles are being followed by the risk management activities or risk practitioner within the organization or not. There could be another approach by which we take our audit activity by ensuring that the process of risk management is being followed or not. And the third way of doing an audit of risk management is by maturity model. So capability maturity model is a 5-step model, and there is a new version of the same model which has 0 in the start. So from 0 to 5 or 1 to 5, you gauge the risk activity based on its maturity, that to what level the organization risk activities are. And the way is you keep these frameworks in front of you and see that how many activities of these frameworks are being followed and managed and repeatedly being followed by the organization, and if there is a continuous improvement that is being followed or not. So these are the 3 main different way of auditing the risk management activity. One thing to keep in mind, if someone asks you that what is the best risk management framework that should be used, there is no best or worse. It depends on the organization, it depends on you. So all the frameworks are good. Some people use ISO 31000, some people use COSO ERM, and some combine these two, and some use, even there are Turnbull and some other framework, risk management framework, that is being used by different people. So there is no best thing, as we have discussed, that it whatever best suits to you and your organization and the culture that you can adopt in terms of risk management framework. Here we are at the end of the session, and just to have a quick recap, in this video session we have covered the basic process of risk management, the key principles and the standard. We have talked about the 3-line model, IIA. We have gone through the 2 risk management models, ISO 31000 and COSO ERM framework. Within the COSO ERM framework, we have covered the limitation of the framework as well. So yeah, this is the overall snapshot of the risk management entire conceptual framework that we have covered in this unit, and I hope this entire unit might help you to understand much better the risk management activity within a company and the role of internal audit. Just one thing before I conclude this video, because I believe that I have not covered the risk capacity in detail earlier. So risk appetite is basically the acceptable level of risk that a company can tolerate. For instance, in an analogy of a traffic speed limit. So if the traffic speed limit is 70 So that 70 is your risk appetite. If in some countries, for instance in UAE or in Dubai, basically it is allowed to drive up to 19 or 20 kilometer per hour extra than your defined speed limit. So that is your risk tolerance, and beyond that, if you go, you will get a fine. So with that analogy, the maximum speed limit that your car can go, for example, in modern cars you have easily 220 kilometer per hour speed limit. That is your risk capacity. So in the same way, the organization have risk capacity, risk appetite, and risk tolerance. So you can take or keep that example in your mind while understanding this critical concept. Other than that, I believe I've covered everything. Yes, you will find a little bit weird formatting. Not formatting, like there might be a little bit intro, a bit not very seamless, because certain slides have recorded at different time intervals, so it might be a bit strange. But overall, I have covered the entire course, and most likely you will find the summary notes for this unit in the description column of the video. Thank you for watching, and please remember me in your prayers. Till next time, take care. Bye bye.